Okay, so picking back up here with part three of the recorded lecture, working my way down through this process that auditors go through to evaluate internal controls, thinking through this next step, which is significant accounts and disclosures. And so we identify these significant accounts if basically they're going to have a material effect. If a misstatement could result in having a material impact or effect on the financial statements, right? And so, uh, how do we determine that? Obviously, size. Large accounts relative to the total amount of assets or total amount of sales. How likely is it, or how susceptible is it to loss? Things like complexity, um, uh, the um, in terms of the actual transaction complexity, how complex is it to report, right? Think about, um, like pensions, for example, right? There's a lot going on for pensions, and so that could result in it becoming a significant account, even if the size is not maybe as large as some of the others. Um, if we have related party transactions in that account, then that can raise its significance pretty quickly, right? If we have individuals that are part of the firm that the firm is transacting with, but it's not at arm's length, and that all of a sudden can make it significant. Right, then looking at the relevant assertions, we've talked about these a lot, right? These six assertions: existence, completeness, valuation, accuracy, cutoff, rights or obligations, and presentation disclosure. And I did add cutoff here relative to maybe what your slide says, but that would make it more consistent with what we've talked about for our assertions in the past. Okay, so how do I get to design effectiveness? Again, we're saying if the controls are operating effectively, then are they effective at preventing, that's supposed to be a P, or detecting material misstatements, right? That's an M. There we go. And so they think about the nature of the transactions. So if it's a routine, then, like for example, sales, right? There's going to be a lot of transactions for most firms, not all firms. You can think about, like Boeing is not going to have as many transactions, for example, as Amazon, right? But if they're routine transactions, then presumably the controls should be more established. But also, if there's a problem in the control, then that means a lot of potential transactions are susceptible to a material misstatement, right? And so we want to consider that routineness. Non-routine ones, things like pricing inventory or counting inventory, those happen pretty infrequently. But because they're infrequent, they may not operate as smoothly as the other controls, right? And so that's something that we'd want to consider when we're thinking about its effectiveness in terms of controls over that process. And then the last category is estimates, right? And these have judgments, the allowance, warranty reserves, impairment, some of the pension estimates that go into it. Uh, so, these can be significant areas, and so we'd want to evaluate how effective those controls are operating around the estimates since they do contain so much judgment. Okay, so then what are we going to do? We're going to do a walkthrough, and that's basically you're going to trace a transaction from its origination up until the transaction gets to the financial reports. And what are you going to do there? One, you're going to look for points at which there's a significant risk, right? Um, so maybe there there might be a step where you have a bunch of sales transactions and they get input into the system, but for example, there's no check to make sure that the total amount that was input matches the total amount of invoices that the person was supposed to input, right? That would be a point in which there could be a significant risk. The other thing that a walkthrough does is it helps verify understanding of the design, right? So we're going to talk through the design, but then as we're walking through the transactions, we can see where those controls should be coming in, right? So it kind of helps verify the auditor's understanding of the design. And then at times you can evaluate the effectiveness of how well it's designed when you're doing the walkthrough by thinking about, well, how could this been changed here or manipulated here, right? Where's there a weak point? And doing the walkthrough helps you be able to identify those. And then also helps you confirm that they've actually been implemented, the controls are actually implemented. And so walkthroughs are a big part of kind of evaluating the design piece. Okay, so then kind of once we get to that understanding entity level controls, once we understand the flow of transactions, then we're kind of taking a big picture look to think about, okay, where are the points that we could get a misstatement that could come up, right? So we're going to look for specific points within the process, and then identify any controls that have been put in place, and then making sure, so this is kind of financial reporting piece, then when we're thinking about misappropriation of assets, then looking for controls that help prevent or detect any misappropriation of assets that could ultimately result in a material misstatement, right? So, if you had a bunch of assets that are stolen, but you're saying that was part of cost, part of cost of goods that were actually sold without recognizing that they were stolen, and you still have think there's assets on the balance sheet, right, then that would be a material misstatement. All right, so looking at how do we select which controls to test, obviously we're not going to test all controls, and we don't have enough time, right? So how do we start paring down which controls to test? Obviously, if you have redundant controls, you don't need to test a duplicate control, right? You can test one, but you don't need to test another. Then we're going to think about tests that we're going to create to see if these, especially preventive and detective controls, are working. Obviously, if they're complementary, so another word for redundant is substitutes, right? But if they're complementary, then you have to test both of them. So if you have controls that are kind of meant to work together, then that's when you have to test both. So what do some of those tests look like? Again, right, these are 3 components we can vary with testing: nature, timing, and extent. It's the same for control testing as it would be for substantive testing, right? These are the 3 things we can vary. And so we can do things like doing inquiries, inspections, observing the process, and reperformance. Obviously, this one is the most powerful, right? If we're talking about reperformance of a control. Inspections also can be stronger, or can be strong as well. Whereas if you're just talking to someone or just observing them do a small number of transactions, it's not as good as being able to reperform and do inspections. So when we have data, right, and we're doing data analytics, so for example, if we had a transaction authorization, that we wanted to test, and we had one of the columns in the data file for the invoice table was for an amount over a certain dollar amount, it required a separate authorization, and that person's initials would show up in that column, for example. So if that's the case, and assuming that the system required them to have to put it in, then we could get that data, and we would actually be able to test and inspect to make sure that control was actually done for all those transactions that meet that that control threshold. Obviously, with any test we're doing, we want to vary the test from year to year, right? So the client doesn't start assuming and knowing what we're likely going to do, right? Because then that's when they can potentially start gaming things, either purposely or just recognizing that they may have a limited amount of time. And so if they're like, oh, the auditor never looks at that control, so don't worry about it as much, they're not intentionally trying to commit fraud, but it's more likely that they might not be as effective in that control if that's the case. So that's nature. Timing uh, depends on when we're going to do it, right? Is the timing. And so, depending on how often uh, it happens, if it's one of those routine transactions, then we can do some control testing throughout the year, right? Q1 we can do some, Q2 we can do some, Q3 we can do some, right? We can kind of do some throughout the year. We don't have to wait until the end. Now, um, if we start seeing problems and they need time to fix it, and depending on when they fix it, right, then we may have to come back and deal with it towards the end, because we want to make sure that we can get to a place where we can, and you'll see in a minute how the report might get changed, but we want to ultimately be able to test to make sure if they are fixing any deficiencies, and so that's why we might do some early and then some, after fiscal year end, or before whenever the report date is, right? So if the report date is fiscal year end, then you want to do it before that. But if the report date for the opinion is later, then we might have to, or we might be able to wait after fiscal year end. So we got nature, we got timing, and then extent. Again, that depends on the frequency. And there's a nice little table here on the next slide I'll show you. Right, and this one just kind of gives, this is an example of the guidance they give. So as the frequency, they kind of have this reversed, but frequency here is increasing. As it increases, right, instead of once, this is once a year that it happens. This is 4 times, right? This is 12. So as the frequency goes up, then obviously the number of times to test it goes up, right? Just because ultimately it gets to, is this sample sufficient to cover how often the control is being performed? And so this is just one firm's guidance, but kind of the takeaway is the more frequent the control occurs, then the more number of items you need to actually test to verify. Again, that's assuming you're doing a sample, right? If you have all the data, you can do it for the entire population. But if you don't have all the data and some of it's manual, then you're doing samples. All right, so I'll start up a new video here for the next learning objective.